Hello business owners and welcome to today's tax tip by TaxWise CPA. We are going to talk about the one big beautiful bill that was enacted on July 4th. Particularly, we're going to talk about the SALT deduction increase from $10,000 to $40,000. The purpose of this video to show when this deduction phase out and how to tax plan ahead of time to make sure you get this deduction when you start to make more than $500,000 in net income a year. Let's look at the numbers. What is SALT? SALT stands for state and local taxes. It includes property taxes, state income taxes, and local income sales taxes. We're going to compare a taxpayer who's making $300,000 a year versus someone who's making $500,000 a year to show the phase out limit for this $40,000. We are going to assume that this taxpayer is going to itemize their tax deduction, which means take more deduction than the standard deduction given by the IRS. In this example, we are looking at tax filer who filed jointly or married filing jointly. The standard deduction is $29,200 and we want this deduction to be higher in order to take advantage of this SALT deduction. So if this client who makes the $300,000 a year, they pay $10,000 in state income taxes and they pay $12,000 in their property taxes. Let's assume they pay $16,000 in their mortgage interest. They give a cash contribution for a charitable entity, $3,000. They pay for their personal property taxes for their cars, $500. The total itemized deduction here is $41,500 versus the standard deduction $29,000. So they are taking more than the standard deduction, and if they were at a 35% tax rate, they are saving $4,340 in taxes instead of giving them to Uncle Sam. And the total itemized deduction would be more if they have more deductions or if they are paying more for their property tax, for mortgage interest, etc. In comparison to the taxpayer who net $500,000 a year, their SALT deduction start to phase out at that point. Means they cannot take this deduction anymore. And they will be capped at the old cap of $10,000 deduction. So if they were to itemize, their $10,000 deduction is what they paid for state taxes. They cannot take more for that what they paid for the property taxes anymore because they are making $500,000. And they have the same mortgage interest, same charitable contribution, same personal property taxes. They unfortunately will be able only to take the standard deduction instead of, like, they will get $29,200 deduction instead of $41,500, losing $4,340. In order to get them to take advantage of this tax saving amount, we have to run tax planning at this point. And this is where I emphasize the importance of proper tax planning. So if we were to get their modified adjusted gross income from $500,000 to $400,000, they will be able to take the full amount for the total itemized deduction, including the SALT deduction. How can we get them to decrease their modified adjusted gross income? By applying a customized tax planning strategies to get them at this point, reducing their modified adjusted gross income by $100,000. There are lots of strategies that we can study the case for the client and set it up for them to reduce their modified adjusted gross income. Reach out to us if you have any question on this.